Well, this is a $4 trillion bill over 10 years, $5 trillion if they make the tax cuts permanent. And it's a massive transfer from the bottom to the top, because remember, you are extending the 2017 tax cuts, which helped everyone, but were still skewed toward the top. There are add-ons above and beyond the 2017 tax law that primarily help the top as well. And then to the extent that they are trying to pay for this, and again, they're not fully paying for this by any means, but the cuts to Medicaid and SNAP food stamps primarily hurt the poor. So net, like you were saying, this is, nearly $700 if you look at the bottom 20% of families, and then a $30,000 benefit net when you look at the top 1%. And that's not even accounting for tariff revenue, which is not part of the bill formally, but which the administration is framing as a pay for. And those are also quite regressive taxes.
So I'm guessing you would not have voted for the bill here, Ernie. The thing is, every time we spend time talking with Republican lawmakers, the conversation immediately goes to the CBO and how this nonpartisan operation that's been part of the process here for generations has been politicized and is looking at the wrong numbers, doing the math wrong. How do you respond to these constant attacks on the CBO and the suggestion that, you know what, Ernie, you're also wrong because we're going to grow out of this debt?
I would say, first of all, CBO, to anybody that's worked with them, knows that they hold analytical rigor and nonpartisanship as two of the highest standards for the organization. What's great about CBO is that they do things consistently and, for the most part, transparently over time. So that they are going to analyze a bill against current law, against the law as it is currently stated. That was not a surprise. As a matter of fact, this Congress, particularly the Senate, tried to come up with a different way of looking at it because they knew exactly how the CBO was going to look at it. It is perfectly fair to say that when you cut taxes, there is a little bit of a growth dynamic effect that somewhat mitigates the cost. But tax cuts don't pay for themselves by far. Back when the 2017 tax cut was passed, CBO found that the dynamic effects of that tax cut offset about 20% of the cost of that bill. And that was when we had corporate tax cuts as well. Those corporate tax cuts were permanent, so they're not being extended in this version of the bill. It's just the individual tax cuts, which have much less bang for the buck. And so the dynamic effects, the growth effects, should be even lower than they were back in 2017.
Well, Ernie, that's an important point as we consider that this is not a package mostly of tax cuts. It's a tax extension of the rates that were set from tax cuts 8 years ago. So when we consider the actual stimulative effect that this is likely to have, does that basically negate it? Or should we be viewing this more from the lens, which is also a Republican argument here, that it's avoiding those tax rates going higher, which could have had a detrimental growth and consumption impact?
I mean, the thing to remember is that this bill goes above and beyond those mere extension of those 2017 tax cuts. Mm-hmm. So even if you had thought that those 2017 tax cuts, the individual ones that were expiring, ought to be extended, this bill as written is still about $100 billion more expensive than just doing that. And if the expiring provisions in this bill were made permanent, and if there's one lesson we've learned over the last couple of decades, it's that expiring tax cuts have a funny way of becoming permanent, then this is a $1 trillion bill, above and beyond just extending the TCJA. There will be a little bit of fiscal impulse, I think, in 2026. And I think that especially if you are the Fed, or if you are a macroeconomist thinking about your forecast, that's an important factor that will be somewhat offset by the effects of tariffs taking effect, right, which is going to have a detrimental effect on the economy. And so net, you have to think about all of these things in tandem.
Right. So if you don't like this bill, Ernie, and you're worried about debt and deficits, was extending the current policy baseline the original sin?
I mean, look, I think that everybody, including markets, assumed that the 2017 tax cuts were going to be extended. And in the short run, that was probably not the wrong decision to make. I do have sympathy for the argument that if we had let them expire, that would have been a massive tax increase next year, and that would have created macroeconomic slowdown. The
but
thing
the accounting
is
method that they voted to use says it costs nothing because we're extending it.
Exactly.
And I'm still trying to get my head around how that works.
Exactly. The baseline tricks are funny. I like to ignore baselines and just say, look, what does the debt trajectory look like over the next 10 years with or without this bill? And with this bill, debt is growing faster than the economy still. It was already, forecast to grow faster than the economy, even if the tax cuts had expired and we had, raised more revenue as a result. Now it's even worse as a result of this. And so, look, we can have arguments about whether it was correct at this point in the business cycle to let the 2017 tax cuts expire completely. But the fact remains that our debt trajectory is unsustainable, and there needed to be a better way, right, of making making a better tax code and for paying for that in a way that would actually reduce the debt trajectory.
Well, so when we consider that debt trajectory and the debt level, and then consider the level of interest rates as we factor in the payments we have to make on said debt, that's where you get to the argument that President Trump is now making, that this would all work out for the better if the Federal Reserve were just to lower interest rates and help bring down the cost of that debt burden. If we were to see a 25 basis point cut by the Fed this month or in the fall, if we see multiple, Ernie, how quickly would that actually make a difference as we consider the U.S.'s financial situation?
I think a small cut by the Federal Reserve would not make a huge difference. Remember, the summary of economic projections already has cuts baked in for this year. It's just a question of when during the year we're going to see of those cuts. And so I think that that's probably priced into the long end of the curve already. You would need a massive shock above and beyond what is expected from the Fed, to see movement on the long end of the curve. And even then, if investors perceive that the Fed is politically captured, or that the Fed is, taking fiscal policy into it, going beyond their dual mandate and taking fiscal policy into account, right? Then further cuts by the Federal Reserve may be less effective than they've been in the past, because investors, may incorporate lower policy rates into their long-term yield forecast, but then they may inch up their inflation expectations and their term premium as a result. So this, even a Fed that cuts rates may be much less helpful to the argument the president is making than he thinks right now.
So is President Trump the real reason why the Fed can't cut rates?
I mean, I think that the Fed's dual mandate is very clear, right? They are concerned about inflation and they're concerned about employment, and they are stuck in a potential stagflationary shock right now, or a worry of one, right? So on the one hand, they are waiting to see the effect that not just tariffs, but immigration action and fiscal impulse next year will have on inflation, while at the same time keeping a keen eye on how those shocks will also weigh on the labor market. And the effect is the opposite, right? So if there's inflationary pressure, you want to raise rates or not cut rates. Whereas if the unemployment rate starts rising, much more than it has, then you want to start considering rate cuts. And that's a very tough position for the Fed to be in. It is, I don't think it is a simple matter of, the Fed needs to cut rates because other countries are already lower or because of something else.
Well, and Ernie, as we consider the kind of labor market element of the Fed's dual mandate and the picture of the U.S. labor market overall, getting back to this reconciliation bill, knowing it removes subsidies in a number of industries, including those intended through the Inflation Reduction Act to invest in clean energy, would you expect that to have a labor market impact, or at the very least mean that the U.S. cannot grow as many jobs as a result of this legislation?
I mean, I think that the energy side of the legislation could potentially raise energy costs, right, which is a supply side issue that the Fed is so, famously concerned with. I mean, we have had inflationary shocks that have stemmed from higher energy prices in the past. I would also be concerned about the vulnerability of lower income families as a result of both this bill and tariffs, and how that flows through to the labor market. I've always been skeptical of the claims that policy this year would lead to a recession, even when tariffs were higher than they are now. A couple of months ago, I'm not odds on a recession. But I do think that policy creates a macroeconomic headwind for the U.S. And that's something that's going to be a major challenge for the Fed to navigate. Between that and between the upward price pressure.